Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Joining me again is Ron Hera of Hera Research. I'm very happy to have him back. Thank you for joining us today here, Ron.
Thanks for having me on.
Thank you. Now, Ron, you wrote a great article about Keynes early in February, and I was recently, this past weekend in D.C., I was at a Students for Liberty conference, and there was over 1,000 students there and entrepreneurs from all over the United States, and a lot of them flew in internationally, and it was just a growing liberty movement. And we talked about, the problems with Keynesian economics and how it's preventing entrepreneurship. And the venture capitalist and investor Peter Thiel gave this very long speech, about 45 minutes long, about all the bubbles that Keynesian economics has created and central banking has created. And then he talked about how, the entrepreneur really, since 1980s, hasn't really done that much innovation outside of computers, the internet, financial engineering, and maybe some biotech stuff. What do you think about some of these things in relation to Keynesian economics and how it's preventing real productive long-term value creation and growth in our economy?
Well, I have to say I agree with Peter Thiel. In fact, I used to play chess with him back at Stanford. But setting that aside, I think that we have had a decline in business innovation outside of those areas mentioned, not all of which are insignificant. Of course, the computer revolution has really completely changed the world. But there is an underlying economic problem, which is a growing problem, and that has to do with what you might call capital formation. It has to do with where does investment come from? And I think what's unsustainable is replacing capital formation, which comes from savings, with debt, which comes from borrowing. And I did discuss that point in my article, as a matter of fact, that the capital formation comes from excess production. It doesn't come from borrowing, which encumbers the economy with debt and ultimately is a net drain on the economy. So credit expansion is very double-edged, and it can't replace capital formation. That's unsound.
Yeah, and in that article, you spoke at length about how, an entrepreneur like a Mark Zuckerberg or some of these other entrepreneurs that are doing a great job that are actually growing, some productive things that help businesses, become more efficient and sell more products online. And these guys aren't benefiting as much from their, creations as the banks in a lot of cases because of all the debt that they had to use to finance the business.
Well, yeah, and that's because there aren't, in an economy where the monetary system is a debt-based money and it is a fiat currency. So essentially, with certain exceptions like quantitative easing, all money is created by borrowing activity. That is actually how money enters into the economy. So given that that's the case, you have basically a runway from the time that any type of backing is removed from the money to a point where you have basically a kind of debt saturation, simply meaning that bad money drives out good. And the result, of course, is people will hoard any asset-backed money or any assets that they have, and eventually only debt-based money will be in circulation. So, and of course, the inflationary monetary policies discourage savings, and that's what's happened. Savings levels are very, very low in the United States, and so as a result, you have, as we were saying, an erosion of capital, a displacement of real capital in favor of debt or credit expansion, and that's not sustainable or sound. And once you reach a point where only credit-based funding is essentially available, then entrepreneurs have no choice but to borrow. And so the economic benefit of their business activity doesn't accrue entirely to them, but in the worst case accrues substantially, if not for the most part, to the financiers.
Yeah, and I read a lot of stories in business magazines in the last couple of years about, the apps with the mobile phones and stuff like that, like the iPhone and stuff. And these guys are, maxing out their credit card to put an app out there, risk reward there. And that's not, real free market capital formation here where they can go and borrow some money from friends or family members. Everyone chips in $1,000 or something like that. And that's the way the American economy was built, a long time ago and what made it so successful.
Well, there's a couple of issues there. So, yeah, I agree with you about availability of capital and this whole issue of debt replacing capital and that not being a sound way of basically building wealth in the economy. It doesn't create new wealth per se. So I mean, obviously, if you're borrowing money and the net debt is growing in excess of GDP, which has been going on for decades, then you're not really adding wealth to the economy. What you're doing is you're adding the appearance of wealth financed by debt. But more than that, I'm concerned that a lot of the things that we're talking about are ultimately, including some of these internet-based applications, some of these websites, some of these mobile phone applications, they're great examples of technology innovation. My concern is that the business model for so many of these things, if not the vast majority of them, is ultimately the consumer. And that goes right back to Keynes and Keynesian theory that, aggregate demand is what creates a focus on consumption. And this idea that the economy grows as a function of increased demand, that I think is a mistaken concept, because it's really, you have to not just look at spending as if you look at GDP, obviously that's composed essentially of spending, right? But actually you have income. You have to have income first. So if you look at where does that consumer spending come from, it comes from income. So you have to have a growth in income, and that has not happened for consumers for some time. Real income has gone down. Real household income has gone down if you adjust it for inflation. So, the consumer spending, the whole idea that consumer spending can drive economic growth is a mistaken notion, because you have to have income growth. You have to have production growth. You have to have business growth. That's what fuels the consumer spending.
Exactly. And if you consume before you produce, you don't have the money coming in, you don't have the cash flow coming in, you're going to run up massive debt. So that's the problem I see here is the central banks, the collectivists here, the central planners have made a decision to use financial repression to devalue, everyone's debt, and that's the problem, because in capitalism, we're supposed to reward people for doing the right thing, but instead, a lot of the planning policy from the politicians and the central bankers is they're rewarding people for having done the wrong thing.
Well, that's a really good point, because financial repression or even just ordinary monetary inflation, those things actually destroy the value of savings. So it actually destroys real capital. So the idea that we should devalue the currency in order to save banks which have too much debt on their books and crumbling balance sheets, and you're recapitalizing banks, which is inflationary, in order to salvage their financial assets, which are debts, in fact. At the cost of destroying savings is really adding insult to injury, because the whole problem arose in the first place because of the erosion and replacement of real capital with debt. And so now the solution is an inflationary policy that saves the debt but further destroys actual capital.
Yeah, I completely agree. And I think we're starting to see a big dislocation here between the real economy and the paper, capital market, asset market economy, where in the real economy, for consumer staples, for food and energy, we are definitely seeing what, mainstream economists and other people will call stagflation here. We're seeing, higher prices on things people have to have every day to survive, and we're seeing real unemployment rates continue to grow. And then, the capital markets, I don't feel in a lot of circumstances are really reflecting this.
I completely agree. I mean, with the Dow at 13,000 and at the same time the trade deficit, rising, I mean, we have some serious structural problems. I mean, not even to mention unemployment situation. I mean, unemployment has gone down in I guess you could say in a nominal way, just because the workforce is supposedly shrinking. But this is the long-term result of bad trade policies. I mean, so that these things are related. That the trade deficit and unemployment are related, and it's related to outsourcing and so forth. So we have structural unemployment.
Yeah, but I mean, we could create jobs, if the foundation was there, where, those cheaper jobs that are lower profit margin, those cheap Chinese manufacturing jobs that some of these politicians want to bring back and then put up tariffs on Chinese goods. I mean, those are really low-paying jobs, and we don't really want those. I mean, don't we want, higher paying jobs like with what GE used to have, where they would make all these innovative products, or what, Ford and GM really used to do before a lot of the unions destroyed their profit margins, and, come and make these higher paying goods and services that people could only buy here in the United States.
So there's a lot of issues here. as far as what our trade policy should be and what kinds of jobs we should try to encourage. And I would step back from that and say that what's happened is we've had a central planning a policy, central planning of the economy, and the agenda can be described overall as globalization. The whole idea that we should centrally plan and therefore globalize. Those two things go together: central economic planning, globalization. So, this is an agenda for globalization that requires central planning. It's been going on for some decades, in fact, and we're seeing some of the negative consequences. In other words, there's a downside to globalization, which is that if resources and the other economic inputs, resources and labor, can move freely across national borders. And labor is considered a commodity, obviously, then the labor is going to be wherever it's cheapest. So it's going to be in China, or it's going to be in India, or it's going to be in Bangladesh, wherever it is. So that's a problem for developed economies. And so, ultimately, you have to have economic development throughout the world to achieve some kind of equilibrium again. Until then, under a policy of globalization, you have structural decline in the workforce in the West and obviously in the United States. There is no easy answer to that problem. You can't just bring back, supposedly dirty factory jobs and raise tariffs, right? At this point, that's likely to be counterproductive. I personally think that this whole idea of globalization and the level of central planning that it requires, I think that those are both flawed concepts, and that the solution to this problem is actually to have local economies and local sustainable economies, and to let go of this notion of basically exponential economic growth and focus instead on sustainability. And starting at the local level. That's what needs to happen. We need to decentralize. We need to de-globalize. Trade could be global, but you have to have sustainability as the foundation. We don't have that.
Well, I think eventually, as the oil price continues to rise, I think it's just going to make a lot of sense that a lot of the value chain, where a part gets made in China and then it's reassembled in Japan and then sent back to China and then sent back to the United States, I think that's going to end as, oil prices continue to go higher. I think, the free market forces with a higher oil price, because I don't see anything, completely replacing oil anytime soon. I think that's going to end the current global economy that we have right now.
I completely agree with that, and I would say that one of the flaws of globalization, setting aside the fact that it's premised on central economic planning on a global scale, which is a sort of a nightmare if you believe in any kind of human rights or freedom, setting that whole issue aside, the notion of globalization is premised on cheap oil. It's cheap fossil fuels. The idea that you can have labor performed in one, resources could be moved to one part of the world where labor will be performed, and then those goods will be shipped out to other parts of the world. Well, that only works if you have cheap transportation.
Yeah, and I think that's a major reason why Warren Buffett went and bought, Norfolk Southern, the railroad?
Yeah, well, Warren Buffett is way ahead of the average investor in terms of his strategy.
Yeah, and I heard in his last investors newsletter, and he obviously is no fan of gold, unlike his father, who was a fan of gold, but in his last newsletter to investors in Berkshire Hathaway, Warren Buffett actually started speaking about, the bad parts about bonds and money market mutual funds and loss of purchasing power. So I think that was very rare to have him come out and talk about, inflation and the dangers of it so much, because usually he doesn't really like to talk about things like that.
Well, I agree, and I think there is something of a contradiction, if I may say, as far as, Buffett's views on gold and Buffett's awareness of the fact that inflation is eroding the value of treasuries. It's robbing savers and retirees of income and so forth. So the idea that savings and the value of so-called safe investments like treasuries is being destroyed, that's a problem. One way to solve that problem is through gold. However, Buffett's view, to be fair, is simply that, well, why would you want to own an asset that doesn't produce any income and that doesn't grow when you could buy businesses? And obviously, if you're Warren Buffett, you're going to be looking at businesses that have a high growth profile. You're going to be looking at fundamentals. And I completely understand why he believes that you're better off owning shares of companies than you are owning gold. But I personally see gold as an insurance policy, and I wouldn't be without it.
Yeah, I completely agree. And I think to argue something to benefit Buffett, I think he's right that people should be invested in productive companies instead of, bonds and money market mutual funds, because you're getting, higher rate of return from dividend stocks than you are from sovereign debt in many cases.
But
with a lot
not
less
a binary.
risk.
Sorry to interrupt. It's not a binary proposition, right? You don't have to only own gold or gold stocks, and or only own industrial stocks. That's simply not the case. So a balanced portfolio would obviously include all of those things. So, and if you go back to something like the Harry Brown permanent portfolio, you have part in stocks, part in bonds, et cetera. It's a part in cash. So, there's very reasonable ways of balancing your investment portfolio. It's definitely not a binary decision.
Yeah, exactly. Although, like the dollar on the dollar index has held up pretty well against the other G7 westernized currencies, and I think the dollar is going to do very well in 2012. And then I think it's going to surprise people to also see that gold is also going to do very well in 2012, along with the dollar and the dollar index.
Well, that's interesting. I think that the dollar is in a long-term decline, and I think that that's a structural decline. And the fact that the U.S. is basically engaged in a serious deficit spending, that the Treasury has to roll over quite a lot of debt. I think it's about $3 trillion for this year. That the Treasury has to issue and roll over. The Treasury of the United States issues more debt than what the budget deficit is, because they don't actually pay off any of the debts. As long as we still have a deficit, they're actually issuing new debt to roll forward the existing debt, and then also issuing debt to cover the deficit. So the Treasury issuance is much higher than the deficit. It was, I think, $2.55 trillion last year, and I think this year it's going to be about $3 trillion. So, that money, it's not clear if it's going to really be able to come from foreign investors or from the private sector, and I think we're going to see more quantitative easing. And at the same time, the banking sector remains, let's just say, troubled. I mean, let's not forget that the FASB banking regulations were changed in 2009, have never been put back, that, we're not marking financial assets to market, mortgage-backed securities, and even mortgage loans. They're being marked to model or to fantasy, if you will. So the banking system's still in trouble. The federal government's finances are still in trouble. In fact, if you use GAAP accounting and you use the net present value of the future unfunded liabilities, such as Social Security and Medicare, which is well over $60 trillion, that the current budget shortfall of the United States using GAAP accounting is about $5 trillion. So, I just don't see how the dollar is going to really rally throughout all of that. Now, of course, the dollar is always strong relative to other currencies. So
exactly.
I mean, yeah, well, because none of them are based on anything, right? So except the so-called.
Well, yeah, So that's why I think the dollar is going to do well, against the yen, the pound, and the euro. To some extent, the euro is because, the world reserve currency status, we still have that, and that's perceived safety over other currencies. And there's just so much printed money, like it's very impossible to know exactly how many trillions of dollars is floating around all over the world that's been given out. And, the money, all the money can't go into gold. It just can't. So the money is going to have to go somewhere for a short period of time, and that's why we're having probably, I would say, these risk-on, risk-off things, is because there's so much hot money, and it's got to, keep switching back and forth to all these things.
Yeah, that's an interesting point. I mean, the yen is in, Japan's economy is in a recession right now, and the public debt in Japan is very high relative to GDP. So there's really no way that the yen can stay strong. However, the yen has been strong, and it's only been strong because the dollar and the euro have been so weak. It's even required interventions by central banks, the BOJ, BOE, Federal Reserve, and obviously the ECB, intervening to basically weaken the yen. So I think that might well happen again, even though Japan is in terrible shape. As far as the euro is concerned, the problems in the eurozone have basically continued to cause fear and doubt regarding the euro. It's weakened the euro. It's kept the euro weak. It's fluctuated quite a lot. So that's what's been making the dollar look, and the dollar also, I mean, the U.S. Treasury market and the U.S. dollar, it's the biggest currency. These are very deep, liquid markets. And so, when there's a flight to safety because of fear over let's say, the European Union breaking up or something like this, then you see a rally in the dollar. And that's been going on basically since 2008. But that won't continue indefinitely, in my opinion, just because the dollar ultimately is just continuing to get weaker and weaker.
Yeah, and long term, I think the dollar is in the worst shape. I gave the analogy recently that we're just being given with the world's reserve currency more rope to hang ourselves with.
Yeah, I agree, and the world is moving away. So the way that I envision this playing out, because I'm not at all convinced that the euro is going to break apart and that the dollar will be the last man standing. What I think is happening already, I mean, if you believe Gerald Celente, that future trends are based on current events, right? They're formed by current events. So I think that's completely true. It's an accurate insight. And so you look at the current trends. What's happening is that more and more countries are trading in their own currencies. And, so what's happening is the world is already beginning to fragment. The cracks are already on the surface, and they're widening. So the world is fragmenting into trading blocks that will be defined by currencies and by trading relationships. And so the dollar, even though the U.S. financial interests obviously wish to preserve the dollar as the world reserve currency, what will happen is that by default, the dollar will ultimately become one of multiple reserve currencies unless there can be an international agreement to create a new reserve currency, like using, for example, the IMF SDRs. Right now, there isn't agreement. And so what's happening while the debate rages on is the world continues to fragment into trading blocks.
That's some great insights, Ron. And I think, to use another analogy here, I think what's happening is the dollar is in that death by 1,000 cut scenario. And I don't think anyone can say exactly when that last, straw that breaks the camel's back is going to occur. So that's why I think, people need to keep core portfolio positions, in my humble opinion, of exposure to precious metals, whether that be physical bullion as an insurance or wealth preservation hedge, or, exposure to those good quality companies.
Yeah, I think that a reasonable person would be looking to place money in foreign markets. If you're in the United States, you might want to have investments in American companies and in foreign companies. You might want to be holding some cash to be opportunistic in these wildly volatile times. You also might want to hold some foreign currencies, and as an insurance policy, you might want to hold some gold too. So I think it's very reasonable to really look at diversification in a new way and to look at diversification on a global basis. Not just in terms of your portfolio diversification, but really geopolitical diversification.
Yeah, and now I want to transition to some specific commodities. And 2011 was a very volatile and rough year for gold and silver investors, as well as actual precious metal miners, because of the volatility in the paper prices of both monetary metals. In your opinion, what do you think of what happened to precious metal prices in 2011? And do you think we're going to see similar things for paper prices in 2012?
Well, I think, things don't go in just one direction. So, financial markets don't go in just one direction. So, I wasn't surprised to see gold and silver sell off at the end of the year. It would have been nice to not see the correction run quite so deep. But in my view, that just provided a buying opportunity, especially in the mining stocks, which I totally took advantage of. So, these fluctuations will continue. But I think the overall trend, I see precious metals as running against fiat currencies. So the long-term trend, if you're looking at it from a wealth preservation standpoint or in terms of investing in producers, which is what I do, I think that's a winning proposition no matter what happens with the currencies, because these companies actually have assets, they're actually producing, they're throwing, in some cases they're throwing off cash. I mean, it depends on what stage of the life cycle they're in. I mean, they could be exploring, they could be pre-production, they could be a small producer, a mid-tier producer, or a major producer of precious metals. So I invest across that whole spectrum, what I call the life cycle stages of the companies, and I see that as a winning proposition as currencies continue to be debased around the world.
Yeah, and I do monitor a lot of the conference calls for the miners, and I monitor like the input costs being increased in other countries for some of these other larger multinational companies, and they do have rising input costs. But with the gold and silver miners, gold and silver are rising faster on a percentage basis than a lot of the other input costs that go into mining. So I think the gold and the silver miners, you're seeing just record profit margins expansion, and you're seeing record free cash flow that really wasn't even generated for the most part in the 1970s.
Yeah, I think as a proxy, you can basically look at gold versus oil, like versus Brent crude, for example, because the higher energy costs have definitely impacted the mining industry. Mining is a very tough business. It's a very hard business where margins can often be quite low. Companies are effectively liquidating their assets from the moment they go into production, which is very unlike other businesses. It's a dangerous business. So, it's tough for them. It takes some time, and they're going to require higher prices for some time before the profits will actually start showing up. But I think that's been going on in the last few years, and I think at this point we're really at a point where higher profits actually are starting to show up, even in the major producers for gold and silver particularly. There's not a lot of pure play silver companies either.
Yeah, and that transitions me to my next question. Do you expect, we saw Minefinders get taken out recently by Pan American Silver. Do you expect a lot more M&A activity in the precious metal mining sector in the next 18 to 24 months? Or do you think a lot of the producers are going to be scared that, there might be a 20 or 30% correction in the metals, and they're just going to hoard cash and not take that risk of going out and doing an acquisition?
Well, it takes a long time to build a mine. So just speaking just of precious metals or just about the gold sector specifically, it takes a long time to build mines. There are not very many large high-grade deposits. The discoveries today tend to be smaller, they tend to be lower grade, they tend to be further from infrastructure. Depending on where they are in the world, they might be under difficult conditions at high altitudes. In the Yukon, where there are long, very cold winters that make it very difficult, if not impossible, to work there. So I think that given those parameters, and given the fact that the prices are continuing to rise, I think it's clear that certain companies, certain deposits are obvious acquisition targets for the major producers, because major producers are not very good at doing exploration. They're very effective about, when it comes to acquiring resources from companies that do exploration. And that's pretty much how the market breaks down. So I think, to answer your question, yes, there's going to be a lot more M&A activity, but it's not just, there won't be just major producers buying all kinds of companies. There's going to be major producers buying large deposits, hopefully high-grade deposits, but there's some low-grade deposits that are very large where there's a low production cost, for example, in Argentina. So, we're going to see major producers probably take out some of those companies, like Extori, for example. Maybe Pretium Resources might be taken out in that way. But I think we're also going to see M&A activity in the smaller, mid-tier or mid-cap space, where just depending on the actual deposits that they're working from and where their production facilities are, I think we're going to see more companies that are actually junior producers, so to speak, take out some of their neighbors. So yes, M&A activity definitely. I expect to see quite a bit of that this year.
Yeah, I interviewed Keith Neumeyer, CEO of First Majestic Silver, last week, who you're also friends with, and we talked about some of the interview that you did with him. But we asked him a little bit off the record about some mergers, And it sounds like they're definitely in a lot of discussions with a number of companies there. They're looking to pull the trigger on like a junior producer. I know from conference calls, Endeavor Silver is definitely out there looking to be very aggressive, and Great Panther Silver is looking to add ounces too. Because a lot of these guys got into production, with older mines that were already there that didn't have larger resources, and they have good cash flow now, but they need to add ounces to grow their reserves because of the depletion.
Yeah, from a long-term point of view, that's exactly right. Although, with modern technology and underground mining, a lot of these older mines that, go back to the 1800s, for example, where they hadn't been producing for quite some time, it's been fairly consistent that there are often extensions of the deposits that are, deeper down and higher grades. So there's plenty of life left in Mexico, in particular, and in some of these older mines where companies like First Majestic or Great Panther are producing.
Yeah, and I think it's going to be a good 2012 for a lot of the mining companies. I think we are going to see a definite good amount of takeovers. I don't know if we're going to see a couple a month, but we're going to see a good amount of them. Minefinders, I was pretty surprised that Minefinders got taken out for only around $15 a share, but hey, I bought it at like $6 or $8. I bought my position about 18 months ago around $6 to $8 a share, so I can't complain too much.
Yeah, well, that was a good call. I expect more M&A activity, definitely.
Okay, well, I want to transition to one last big topic here, and maybe then you could talk about that effect in emerging markets. I wanted to know your opinion on the inflation-deflation debate that we have continuing on now. And, we have so many different money managers, economic experts, newsletter writers, and there's a lot of smart people on both sides. So I was wondering what your opinion is on that. Do we have both? Is it like only, inflation only in the real economy, or what's going on in your opinion?
Well, yeah, there's different permutations, and I've talked about this or written about this before, but basically, usually the parties that are in disagreement really aren't using the same definitions of inflation and deflation, which you and I had touched on briefly before this call. That you can have inflation, and that could just mean, obviously, the Austrian definition, it just means an expansion of the money supply. There's more money in the economy, and deflation, therefore, the opposite, money leaving the economy. So, for example, right now in the United States, in the broad domestic economy of the United States, you have consumers and small businesses paying off debt at a faster rate than consumers and small businesses are borrowing new money. What that means is that money is actually draining out of circulation, out of the economy, and it's ending up in banks where it's retiring debts. That's the definition of deflation from an Austrian view. So what's happening right now actually is deflation in the United States right now. But that's not the end of the story, because obviously you have policy responses from the government, which is following Keynesian economic theory. They're intervening. They have a huge deficit now. I think it'll probably, they're saying it's going to be 1.1 trillion, but it's over 600 billion for the first half of the year. So I'm guessing that the real number is going to be 1.3 trillion, just like last year, because that's how the numbers seem to me to add up. But anyway, you have a huge deficit from the federal government. Well, that deficit is inflation, right? They're borrowing more money than they're taking in taxes, and they're spending it, in effect, into the economy. And that's basically one of the things that's keeping the GDP positive. If you take the government spending out of the GDP calculation, you'll see that the economy is contracting, which is exactly consistent with the shrinking workforce and with the fact that consumers and small businesses are paying off debt at a faster rate than new money is being borrowed into the economy. So in reality, this is just almost an aside to the inflation-deflation debate, but actually the economy is still contracting. We're still in a recession. There hasn't been a recovery. So
oh yeah. Well, and real GDP is obviously still negative, especially when you're accounting for the inflation of like the energy, food, and stuff like that.
Exactly. So now, well, let's talk about inflation a little bit. So from the Austrian view, it's an increase in the money supply, and I just said that the money supply is contracting in the broad economy, and that actually shows in the, if you do an M3 calculation, you can see that. Although the Federal Reserve no longer publishes M3, but John Williams over at Shadow Government Statistics still calculates it from the same components. So you can see M3, went into a contraction. I mean, whether you call it a double dip or not is almost academic, but we're in a recession right now. So setting that aside, now look at the Federal Reserve, right? I mean, they're recapitalizing banks. They're doing quantitative easing. They're intervening in the market through the Federal Open Markets Committee. They're basically through their open market operations, the OMC, they're actually buying assets, usually treasuries, in the open market. So they're pumping liquidity into the financial system. Well, of course, when the Federal Reserve spends money, it's actually creating it ex nihilo. It's from nothing, right? It's out of thin air, so to speak. So that's pure inflation. So when you look at the net free or borrowed reserves that are being held at the Federal Reserve, you see that chart is a line that goes straight up. That is just an eye-opener, and that's pure inflation. It's a couple of $1 trillion. If you look at the Federal Reserve's balance sheet, I think it's over $3 trillion if you include the treasuries that they bought, the mortgage-backed securities that they bought, et cetera. And that doesn't even include any of the loans. I mean, they loaned out $7.77 trillion to the U.S. companies during the crisis, and $16 trillion globally. So I mean, these numbers are huge. So that's pure inflation because it's basically money loaned by the Federal Reserve at, with 0% interest rates and very liberal repayment terms. So that's, in the short term, that's from a short-term view, that's pure inflation that's being pumped out into the economy. Of course, banks aren't lending, which is a variation on the Keynesian liquidity trap concept, but that's a separate issue. So in other words, you got deflation in the broad economy. You got inflation in the financial system, and that affects the Dow. That's part of what's responsible for the stock market rally that's been going on since 2009. That's part of why the Dow is at 13,000 right now. So that's inflation and deflation happening at the same time. We can also, in a more granular way, we can talk about inflation and deflation in terms of just price movements and say, well, what are general price levels in the economy? Because that's the common way that people talk about inflation right now, as you know. So are prices going up or are they going down? Well, the Federal Reserve claims that core inflation, which doesn't include food or energy, is very low. They say they're targeting 2%. But if you include food and energy or education or health care, then you'll find that, in fact, the actual cost of living is going up quite steeply, and that's very unaffordable for the average American family because it's a deflationary environment right now. So there's inflation happening right there at the same time. So inflating prices at the same time as monetary deflation in the domestic economy.
That's a great explanation, and let me try to put my 2 cents in here, and you could tell me if you agree with some of my points. The deflation in the private sector from small businesses and consumers, there's not that money velocity in the banking system, the American banking system. I definitely agree with that. But the U.S. government, as you pointed out, has definitely hollowed out the middle class, and the federal government is picking up all the spending for the middle class where it is deflating. So I think that's part of the factors. From the other inflationary standpoint, I think what the deflationists are not seeing, the majority of deflationists I read and talk to, they don't look at the whole global economy. So when the U.S. prints, base money supply, right, what we have is the U.S. dollar pegs and all these currency wars, and that's where the inflation is being created. The inflation is basically voluntarily being exported by the U.S. and imported by emerging economies like, China and India. And if you talk to people there and you watch their news programs and you see the companies reporting, they have very rapidly growing, inflation over there. And that inflation, because of the dollar pegs and the currency wars, is then dispersed in their economies, and there's a lag time, and then eventually that inflation, because of our trade deficit, comes back to the U.S. in the form of higher priced goods and services.
Okay, a lot of issues there, but I completely agree with you. The currency war is basically inflationary. It's a race to the bottom with countries trying to devalue their currencies. You could call it a beggar thy neighbor strategy, where countries are trying to cheapen their currency so they can increase their exports and therefore have high employment and et cetera. But you started that whole point by mentioning that there's no velocity of money. The velocity of money is basically tanked in the United States. So that's exactly right, and it's because banks aren't lending essentially. And that's one problem. If that's what I meant with there's a kind of a liquidity trap. The banks, you can put liquidity in. I mean, the original liquidity trap concept is that if you recapitalize banks, then that doesn't necessarily affect interest rates. So if you're trying to lower interest rates and you increase, let's say, bank reserves or so forth, that doesn't necessarily cause the interest rates to go down. This is a little bit different, where banks aren't lending. That's the problem. There's no lending going on in the economy. And the real reason for that is simply that debt levels are too high. So you can continue to bail out the banks and add liquidity, but that doesn't cause lending. And the dearth of lending, the absence of lending, that actually is affecting the velocity of money.
Yeah, and the banks in the United States, like for our listeners out there who are listening to this podcast, I don't know how many of them have tried to get a loan at a bank recently, but the lending criteria is a lot higher than it was even a couple of years ago now. We're not back up to full collateral on a loan or something like that quite yet, but the lending standards are a lot more strict than they were, and I think that's going to restrict that way of inflation in the American economy through the banking system, unless you have like a Dennis Kucinich or a politician like that who nationalizes the Federal Reserve and forces the banks, to give out loans like what would happen in the real estate market with subprime loans.
Well, there's another problem, Jason. And the other problem is that debt levels are already too high. So why aren't banks lending? Well, it's not just it's because they don't think they could make any money by loaning consumers and small businesses money. Right?
Yeah.
Well, why is that? Because they're already saturated with debt. Right? In other words, if the economy is growing and you have an increase in credit, and there's and the velocity of money is in direct proportion to that increased money supply because of the credit expansion, then during the boom, in other words, right, it's easy for banks to loan because income is going up. There's asset prices are going up, et cetera. But in a crunch, if in a decline, in a recession, if the debt levels remain as they are, and that's partially a matter of policy, then banks literally can't make loans. I mean, it really makes no sense to talk about forcing banks to loan because you're talking about forcing them to lose money. And the problem is the debt levels are already too high, and once the economy actually has contracted, right, then those debt levels are even higher relative to actual income, relative to the actual business activity in the economy. So they can't lend. Right, that's the problem. It's not.
Yeah, I agree. No rational banker is going to lend money, but that's the problem. Is the politicians have taken control of a lot of the economy, especially with. You wrote in your article about the negative feedback loop, where the banks basically committed fraud, but the politicians were basically telling them, well, you basically have to give out these loans to buy houses to these people that should have rented. So I think what we have now is, for lack of better terms, a negative feedback loop, and I just see things in the United States economy. I see things getting worse before they get a lot worse, before they get better, because there's, like you said, too much debt, and until we resolve the debt issues, we can't have a real, recovery.
Yeah, I agree with that, and I would point out that the damage is done. Right. So when we're saying, gosh, consumers are struggling, they can't refinance their homes, they can't even consolidate their debts, for example. Small businesses can't get a loan to grow or to invest in, building a new product. These are all problems in the economy. And it's easy to look at that symptom and say, well, gosh, if only we could make the banks lend again. Right, but the problem is, as we were saying, that there's already too much debt. So in other words, the government policies that helped to create this situation already broke the system. Right, it's already broken. The damage is done. right?
Exactly.
Now, all we're talking about now are the consequences. So the idea that we could somehow, turn back the clock and, or just change the lending criteria, or so, all of these things are just superficial. They're not addressing the real underlying problems in the economy, which is that the debt levels are too high.
Yeah, exactly. And I think that's the problem with the politicians is longer term, they don't care about it. The majority, well, except for Ron Paul, the majority of them really don't care about a long-term fundamental solution. I was at this conference that I alluded to earlier in our discussion, and, I sat in on a class for taxes, and they have just each state and the federal government just have more and more taxes planned. The Simpson Commission has what looks like a value-added tax that's going to be layered on. We're not going to remove the income tax where I was talking with a tax expert, and he said, if we replaced everyone's income tax with a value-added tax, that might not be a bad idea. That would be more efficient. But they're just going to layer on more and more taxes, and then they're going to devalue the debt and create more inflation. And inflation is a tax on top of that.
Well, so now we just come to the heart of the matter, which is that one of the biggest problems in this whole equation, how we got to this point, what's fundamentally broken in our economy, and how can we fix it? How can we actually get this country back on track again? And the answer is that we need to reduce the amount of intervention in the economy by the government. And when I say that, I'm including the corporations that call a lot of the shots. I'm including the big companies that are lobbying the government to get their laws passed, all the lobbyists writing these regulations and so forth. That's an even bigger intervention. So there's a nucleus of central planning that includes the big companies and the government itself. One solution to that problem, the one that I favor, is cut the government, downsize the government. The government itself is too great of a burden on the economy. Increasing taxes will further encumber economic growth. Redistributing wealth doesn't create new wealth. Adding on more, for example, more national security, if the government hires more people or buys 30,000 drones to fly around, that doesn't really produce new wealth in the economy.
Exactly. And, when all of these tax consequences and when all of these pork projects and all these other things, to use an Austrian term, we just have misallocation of capital and resources. So where there is real demand growth for certain things, that money is not being properly allocated to, which is why I see, in the real economy, I see worsening stagflation for consumer staple items, for the things we have to have every day to survive.
Yeah, I completely agree with that. Whether you want to frame it as the current situation as malinvestment or not, or just say, let's use common sense and say, the government deficits are just putting, good money after bad, that, increasing taxes is going to make the problem worse and not better. And so that's really where we're at.
Yeah, and then we're right back in a lot of senses, although, we had a deflation in the Great Depression 1929, but from a tax standpoint, we're right back to the, the Herbert Hoover FDR thing where I think the income taxes were raised above 60%. I think they touched a level of 80% under Hoover. How can you have any kind of free market where people are willing to make any kind of investments, to set a price floor where business starts making investment in long-term projects again when the tax rate is that high? So I just completely disagree with a lot of the people that were taught in schools that, the government had to intervene in 1929 to save capitalism from itself. There wasn't real capitalism then because we had all these tariffs, we had all these farm subsidies, the Smoot-Hawley tariff, and then we had, the tax rates so astronomically high that entrepreneurs and businessmen, how are they going to make any investment?
I agree with that, and not only that, there is an implicit fallacy, which is that history is written by the victors. In other words, the government did intervene in the economy in multiple ways. They did raise taxes. They did have price controls during the Great Depression. Various things were tried, and eventually the Great Depression ended, which therefore they claim vindicates all of the things they did, which obviously some of them, obviously some of them were absurd. Now, just think about it scientifically. What we can never know is what would have happened if they hadn't done all those things, or what would have happened if they had done some of them but not other ones, right? It's all hypothetical. It's a thought experiment, right? But all I'm pointing out is that the claim that the government's policies throughout the Great Depression solved the Great Depression, that's a logical fallacy. You cannot make that claim.
Exactly, but like you said, when the people win the war or something, they get to write the history books. But back to your point about the hypothetical, I think based on a lot of evidence I'm seeing, I think what would have happened was we would have had a recovery like what happened in the Great Depression 1920, where in 18 to 36 months, the businessmen would have adjusted, consumers would have adjusted to the new economic environment, people would have saved their cash, they would have figured out, what the rules were if the taxes were low, and, people would have moved on. Because one thing good business people are good at better than the government is they're good at adjusting to the, the economic conditions. And that's the problem, when you have a saturated, when you have capitalism in quotes, or crony capitalism, you have too much debt saturation, and, you have all these rules and regulations, is you can't have an adaptive economy then, and that's what you need to do to have prolonged long-term, real GDP.
Yeah, and households use the same kind of common sense that you're talking about, what businesses would do if there wasn't any government intervention. That's exactly what the government should do. I mean, if you have a loss of income, or if you have an investment and you lose your money, or you let's say you, heaven forbid, but let's suppose you had a job, you lost your job, or you get a lower paying job. If those things happen in your own personal life, the first thing you do is you cut expenses. And you start to look at, how you can manage whatever savings you have. You start to look at how you can move forward from that point. We're definitely not doing that. I mean, that's what businesses do too. If you're a business owner, especially small businesses, if revenue falls off, you start cutting costs, and you cut as much as you have to keep pace with that actual revenue. Why? Because you don't want to go out of business. Only the government can keep spending and even increase spending when the income is falling. And now they're talking about raising taxes to make up the difference. Well, I got news for you. There is no combination of taxes or conceivable economic growth that's going to bail out the U.S. economy. So maybe the right answer is cut the government.
Yeah, I agree. And, if we have the right people maybe elected like Ron Paul or others, this can get solved. Politicians who are willing to put the long-term sake of the country and the economy before their own interests. And I think that's the problem, is we have too many rent seekers. People are not focused on long-term value creation in D.C., in Wall Street, in corporations, running corporations for the most part. And, this is going to have to change. But the government, after being at this conference here and listening to tax experts and a lot of other people present and being around D.C., the government sees itself as basically a corporation where, like you said, it does not have to cut its spending, and it sees things like the wealth effect where, it prints anytime the market dips, it prints more money to boost nominal prices, so it keeps its tax receipts the same or higher. It sees that as a return on investment. So if they spend, $200 billion to the stock market as a capital injection, they see that they're going to get, $1 trillion or so as a return on investment for people who sell their assets, for nominal paper gains. And then they see all of these tax increases as additional revenue streams. So I think this is the problem, like you said in your article with Keynes, government is a Leviathan. It's creating more and more revenue streams instead of being forced, to cut back.
Right, and what they don't understand is that they're actually destroying economic activity. That's the real problem here, is that it's a rent-seeking approach. And it's, these additional taxes, it's basically becoming like a toll bridge society where, consumers and small businesses encumbered by more and more regulations and fewer choices have to continuously pay in order to participate in the system. And the idea is that, the government and the companies that are in that nucleus of central control, they see that as additional profit, as additional revenue. And what they're failing to grasp is that is actually destroying wealth. It's preventing the creation of new wealth. It's consuming savings. It's consuming wealth. And this leads to economic collapse. I mean, that is the end game unless these policies change.
Exactly. And I want to transition a little bit, since we talked so much about the U.S., I want to talk about another large economy that affects a lot of the world. And I think, they're going to be the leaders probably in 30 or 40 years. It's debatable how much they are right now, but they are doing a lot of production. I want to talk about China. And if you think they're in for a hard landing, a soft landing, and what do you think about China's, currency wars here with their dollar peg? Do you think it's sustainable, what they're doing, based on their trade surplus, or do you think this is going to end in absolute total disaster for them too?
Well, I think the United States experienced many recessions and depressions and many banking system panics and failures during its evolution into the largest economy in the world. And I think that the idea that coastal real estate in China being in a bubble is going to cause the Chinese economy to collapse is a complete exaggeration. And there's a lot of issues there. For example, in China, investors in real estate actually put a significant amount of money down, whereas if you look at the real estate bubble in the United States or even someplace like Ireland, I mean, people really weren't putting any money down. In some cases in the United States, you're actually having people finance the property in excess of the value, basically borrowing more money than the property was worth, although that was the case anyway, but even more than the nominal price of the property, in anticipation of the property value rising. So that was completely unsound and unsustainable. And if you had just had, for example, a requirement for people to put 20% down, then that simply wouldn't have happened. You wouldn't have had the rampant speculation, the reckless subprime lending, if you just had that the lending criteria be more strict. Well, they are more strict in China. So, I don't think you're going to see the same kind of real estate collapse in China. Also, China's population is obviously very large. It's 1.33 trillion last time, or billion last time I looked. There's a lot of rumors about ghost cities and so forth, but you got to realize that it is a centrally planned economy, and if you go back to some of the same places a year later, I think you'll find them occupied. So I don't think that while there may be some disruption in China, there may be falling real estate prices, there may be some of the local governments, the regional governments are involved in some of this investment, and they're going to take a hit. But does that mean the Chinese economy is going to fall in depression? No, I don't think so. I don't believe that at all. Now, as far as the currency is concerned, they have no choice but to try to keep pace with the dollar and the euro, because the Eurozone, the European countries collectively are the biggest consumer of Chinese goods, and the U.S. is the biggest single consumer of Chinese goods. So they're going to have to play along with Europe, for example, working with the EU to, on maybe some of the bailouts or those kinds of things, and certainly in terms of trade policies, they need to work with Europe, and they need to be able to export to the United States. So they're going to walk a fine line between their trade policy and trying to be a good neighbor and trying to keep their currency as weak as they can, essentially.
Yeah, and you nailed it, Ron. And I think what China is also doing, and Eric Jansen of iTulip talks about this for our listeners who want to go look this up more in depth, is China benefits very heavily off the system that you just described, where, they do the dollar peg and they do benefit, from cheaper exports. But China hedges their, exposure to that with the paper fiat currencies. They hedge that with their hard asset exposure by buying more gold, by buying, more oil, et cetera, et cetera.
Yeah, and they're also shedding U.S. dollar currency reserves because they see the handwriting on the wall, right? I mean, they don't want to be caught, holding $800 billion worth of treasuries at the end of the day. So, they're going to play along, participating in treasury auctions, but ultimately they want to shed dollars, or they want to shed treasuries, they want to buy resources around the world, and that's what they've been doing, but they've been doing it very slowly, very strategically, very systematically. Copper in Afghanistan, or Democratic Republic of Congo. So, I mean, the Chinese are everywhere. They're doing oil deals. They're pursuing
farmland in Iowa.
Right, exactly. They're pursuing their own interest. They're not going to be caught holding the bag with U.S. paper.
Yeah, and they're making strategic long-term plans because they understand what you have alluded to recently about, the end of cheap everything and basically peak commodities in a lot of these cases where, we're running into issues with continually increasing production for, light sweet crude, for copper in a lot of cases, for gold. There's a good argument to be made that we're close to peak gold, especially when you look at grades.
Yeah, I mean, I'm not, going to make a Malthusian argument at all, but if you look at the increase in population versus the production curves for natural resources, I think it's clear that we're looking at higher resource prices, higher commodity prices in the future. So there's really no question about that, and that only is. I mean, that's just a population assumption. If you look at the actual economic growth and technological development in China and India, then it's absolutely compelling that resource prices are going to rise. It's a little bit hard to pick the exact timing for a particular commodity, and obviously the West being in decline, and I'm talking about Europe, the UK, and the United States, all basically in recession. Greece is in a depression. So these are very bearish conditions for natural resources and commodities in terms of demand from the West. But,
for the industrial ones?
Well, yeah.
Especially,
well, yeah, like the base metals and copper and things like that. But obviously India and China are still developing. Now, they are somewhat dependent on the West. So I'm not saying, well, very dependent on the West, really, from a trade point of view, particularly China. But so I'm not saying that, these resource prices are going to skyrocket. They're not going to shoot the moon in 2012. Right, but the long-term picture is very clear. The long-term trend. There's a commodities bull market. It's not ending anytime soon.
Yeah, and grades are declining in a lot of cases very, very rapidly. And, these large companies, these ExxonMobils, which ExxonMobil just had a very large drop-off in the last couple quarters of their oil production just unexpectedly. And, BHP Billiton and some of these other guys, they need to go find new deposits because of depletion. So I think along the way, some of our listeners, if they, want to go look at your newsletter, Ron, they can go and find some of these spectacular resource stocks, the higher quality grade deposits that are going to be put into production that have good project economics that the larger guys will want to buy because they have depletion and because, their production, they're worried about their production dropping off.
Yeah, so I look for production track companies specifically, and I try to cover the whole resource sector, although it's quite a large space. And to be honest, my expertise isn't as deep in every area as it is in certain ones. So I mainly cover the precious metals, but I also cover some oil and gas, some uranium, and other things as well, a little bit of rare earth elements, some agriculture. But basically, what I'm looking for is to acquire resources at a point where they're undervalued. So I'm looking at companies that have a discovery or that have a resource, but where there's the potential for that discovery or for the resource to be a multiple of its current size. So, for example, I just bought a company called Queenston Mining, where the company today has resources and reserves of 3.4 million ounces of gold. They're operating in Canada in the Kirkland Lake Gold Camp, which is a great area. There's a number of mining companies or operating mines there, actually. And the company expects that in the next couple of years, they're going to be able to increase their documented reserves to 8 million ounces. Well, so you're going to go from 3.4 million to 8 million ounces, and they're going to move towards production. So it's a production track company. So whether they reach production or whether they hit the 8 million and get taken out by a major producer, I don't care. But it's just an example of the fact that I'm looking for resources in the ground where they're undervalued, where, especially if they're near infrastructure, where the grades are good, where the deposits are large, and I'm looking for those kinds of things, but most of them are pre-production. So I'm looking for, before you can use financials to analyze the company, before you can use ordinary securities analysis, I'm looking at the assets of the business just from a pure hard asset standpoint and trying to find the companies where I can basically get the most gold per dollar. Or another way to say it is the most gold per share of stock.
Exactly, and I think that's a really good strategy here, because if you pick out the juniors, and the juniors are very tough, most people, especially newbies, should not be buying any individual junior stocks. There's people out there, who do gambling, who don't have any expertise investing in the sector, and they just throw money at a dartboard, or they buy a couple of the wrong companies and lose money, and I've heard those horror stories. And, you have to understand how the juniors work, and the juniors, the best ones, are the ones that, add the resources, that do the project economics, that will either go into production on their own and have good project economics. And because of that, that's why a larger company with cash flow would want to buy them.
Yeah, I agree with that, and I would emphasize that, for somebody who's not familiar with the space, that doesn't have, an investment theory, that's not pursuing a specific approach, that doesn't really understand what these small resource exploration and development and small producers, what that space is about, they should definitely not try to rifle shoot this, because you really, that's a roll of the dice. There's a lot of newsletters, there's a lot of companies, a lot of them are doing promotion, they're trying to raise money to continue their exploration programs and so forth, but a lot of these resources, they're just too low grade, or they're just too small to really be interesting from an investment standpoint, where, they might not make it to production. There's a lot of factors, like the executive team, or what the share structure of the company is. There's a lot of issues, their access to capital, how much working capital they have, what their capital requirements are going to be to get to the next stage, or even for this year's exploration program, if they're doing exploration. A lot of considerations. If you're not familiar with the space, do not try to buy individual stocks.
And that is some great insights from Ron Hera. And, people really need to be willing to spend that extra money to go and get the right newsletter, the right information and education before they allocate capital into those types of companies, or they are going to get burned. They're going to wake up one day and look at their account. They're going to see very large signs of red in those stocks. It is not for the faint of heart, especially junior mining sector, when a lot of these companies are really just selling bad paper. They're really just destroying shareholder value and diluting the shareholders, so the CEO of the company can, pay themselves large salaries, drilling holes that probably won't hit anything.
Well, I think most of them actually, have high hopes for the future, but not all of them actually have the goods. I mean, not all of them actually they're not all in the right places. They don't all have good discoveries. Not all the resources are of good enough grade. And to be frank, a lot of the teams don't really have the right expertise. So it's a very risky, in fact, I have a life cycle approach where I define different life cycle stages. The first one is exploration, which is where the vast majority of the companies are. And I actually call that, there's two things about it that are interesting. One is, what is the risk level? And the other one is, what investment objective does that fit into? So the investment objective is speculation. It's a roll of the dice. And the risk category, according to my system, is extreme risk. Right, like extreme sports, right? I mean, you're gonna break something, right? So
high risk, high reward.
Exactly.
Yep.
So the next level up, obviously, is where they have a discovery, and in my model, they're a production track company, because I'm not interested if it isn't production track, right? Like, I don't usually buy pure exploration companies, even if they have a discovery or even if they have a resource, because I want to see real wealth be created, and that comes from production, in my opinion. Obviously, discoveries have value too, so I'm not going to exclude completely the whole category of exploration. I don't. I do invest in exploration companies. But anyway, the next level up, where they actually have a discovery or a resource, and it's a production track deal, which means a lot of things, including the management team has the expertise to actually put something in production. But that, I call it high risk, and the category there is aggressive growth. So it's actually just high risk and aggressive growth versus extreme risk and speculation.
Yeah, exactly. And what I like to do is I like to sprinkle some of these stocks in where I have, the majority of my capital in safer companies that are, close to production or already in production that are generating profits and cash flow. Because, it's fun to pick out some of these winners if you know what you're doing and do the research. Some of the gains you can pick out are, absolutely phenomenal. You can get couple 100% return or more in some of these stocks if you know what you're doing.
I completely agree, and not only that, I would say that it's a very volatile market, especially the precious metals. So we're talking about gold and silver producers specifically, whether they're actually producers or they're pre-production, but they have a large viable deposit. That would mean that they've gotten to some kind of preliminary economic assessment or pre-feasibility, or a full-blown feasibility study. But having said that, a lot of these companies, the prices have big fluctuations. So I try to buy the stocks, in other words, I'm a value investor. But that doesn't mean that I'll just buy at any point because I think the market's going up, right? I mean, I have a large watch list of companies that I actually monitor. Some of them I've purchased, and most of them I have not. And the reason is that I'm looking for a good entry point. Like earlier you mentioned Endeavor Silver. I like everything about that company except for the fact that it's very hard to find an entry point significantly below the 52-week high. There was one such entry point last year in, I believe, October. And I don't think there's been one since. Now, I don't even think there was one in December, although that would have been your next best shot, would have been December 2011. So it's hard, I have a large watch list where I look for an entry point, and that entry point, I'm going to compare it to the 52-week high, and I'm going to look at the long-term stock chart like a 5-year chart, right, or at least a 3-year chart. And I'm looking for an entry point where I can actually, now I've already evaluated it and determined that it's a good value play, that it's a production track company, is a viable resource, that the team is competent, et cetera, et cetera. And now it's on my watch list and I'm just waiting for an entry point, which may or may not ever come. And obviously if you plan to make money, you don't want to chase a stock up market and pay a premium just to get in. Obviously when the market is celebrating, there's 100 reasons to buy. That's when, ideally you would be selling, not buying, if you're a value investor.
Exactly. And the market does have a premium on Endeavor Silver, and it's because of trust management. They're hitting the numbers or exceeding, the production and earnings guidance numbers. I think you will see that entry point on Endeavor Silver, in my humble opinion, after they do their acquisition, because the management team has said multiple times recently, and I know they're out there looking to buy a deposit or buy a junior producer or a near-term producer. So I think after that acquisition is done, I think you will have your opportunity to go in there and purchase that stock, because they're going to I trust the management team there. I think they're going to go and find a deposit that's going to add a lot of shareholder value.
Yeah, I think it's a good company. So, I look for deals where I can get in at least, 40 or 50% below the 52-week high. And so that's looking at it on a 1-year basis. There are many other special situations where that might not be the case. However, those opportunities abound in a volatile market. I mean, look at, let's say, Colossus Minerals, for example, which is a platinum, gold, palladium play in South America. That's had big entry points where there's opportunities to get into this stock. And if you look at the resources, how big and how rich these resources are, I mean, barring some kind of resource nationalism or intervention by the government, that looks like a pretty good play. And if you can get it well below the 52-week high, I think that's a reasonable risk to take, at least for me. I should say I'm not a financial advisor, nor am I a stock broker. I personally am a value investor. I manage my own money and family money only. I do not invest money for other people. I'm not a financial advisor.
Yeah, exactly. And we're just giving our opinions here on stocks, and this is just for information. Everyone needs to go out and do their own due diligence. That's very important, and that's something that Wall Street for Main Street, which we're an investor education company, which we preach a lot. We want to teach people how to fish for themselves, not, actually go out and hand them fish.
Amen.
Well, in wrapping things up here, Ron, I just want to thank you. This was a very long and enlightening discussion here, and hopefully we'll have you back on soon. And can you please tell our listeners how they can find your work and if they're interested in signing up for your newsletter? Yeah,
I mean, you can just Google Hera Research, and it'll bring you right to my website, or just type in HeraResearch.com. It's HERA Research.com.